I'm going to be moderating tonight's panel on the topic, what really happened at GameStop. So the poster child for the meme stock craze, which really started in January of last year, was a company called GameStop, a thinly traded, poorly performing computer game retailer. And back in April of 2020, GameStop was trading at under $3 a share and had been trading in that range for quite a while. But something happened in early 2021 following a fairly slow, steady increase in the stock price in late 2020 and early 2021. The shares of GameStop jumped 62% on January 22nd, with almost 200 million shares changing hands, as opposed to the 3 or 4 million of typical trading. Then rose 18% the next day, then went up 92% the following day, and finally rose 134% on January 27th, when the stock closed at a still record high of just above $347. Intraday, it traded, I understand, as high as $700. So this valued at $347 per share, the company was valued at about $23 billion. And that was a 12,293% increase from its April 2020 $3 price. The gains prompted rallies in other so-called meme stocks, such as AMC Entertainment, Kohl's, Bed Bath & Beyond, triggered trading restrictions and capital calls on broker-dealers by clearing agencies, congressional hearings on the fair treatment of retail investors by Wall Street hedge funds and market makers, and approach to stock price manipulation by the SEC. The popular narrative was that the GameStop incident was a David versus Goliath battle between small investors and powerful hedge fund professionals who were shorting the stock. And shorting they were. The ratio of borrowed shares to total outstanding shares at GameStop spiked to an unprecedented, really, 140% during the January event. And for several days, the little investors beat out the big ones and captured the imagination of people with no interest in the stock market otherwise. And in fact, a large hedge fund, Melvin Capital, collapsed as a result of GameStop and was rescued by Citadel Securities. During this period, the famous fintech Robinhood, along with several other brokerages, restricted trading in GameStop and a handful of other meme stocks after the regulatory deposit requirements for settling and clearing the securities skyrocketed. That caused a drop in the stock price because buying was restricted at the brokerage, but selling was allowed. And a month later, GameStop was trading at $40 a share. Today, it remains highly volatile, having traded this month as low as $77 and as high as, Larry said, $180 per share. And there were many explanations about what was going on, ranging from the classic short squeeze to the power of social media influencers like Reddit guru Roaring Kitty and Elon Musk, to investor enthusiasm for the appointment of a few new GameStop managers, but really the facts were in short supply. The congressional hearings that were held after traders complained shed little light on the subject. The SEC, however, produced a staff report in October of last year that concluded that everything worked largely the way it was supposed to in the equity and options markets during the GameStop episode, and in particular that a short squeeze or gamma squeeze in the options market didn't explain trading and price changes. The report made some fairly anodyne suggestions about areas of future research, but recommended no specific changes to market disclosures or oversight. But a new report by a group of prominent legal and business academics, two of whom are with us here tonight, suggests a different conclusion may be appropriate about the role of short selling and suggests that market policies may need some adjustment. So what really happened to GameStop stock trading in late January 2021? What issues with market structure did it reveal? And what lessons should market participants and regulators learn from the experience? These are our topics tonight. We'll take about an hour for discussion and then 30 minutes for audience and online questions. For those online, you can submit questions through the Q&A function on Zoom. Before we go to the meat of things, let me briefly introduce our speakers. Joshua Mitz, to my left here, is currently an associate professor of law and the Milton Handler Fellow at Columbia Law School. Josh uses advanced data science in his research, on corporate and securities law, and his primary focus is on informed trading in capital markets and related topics in law and finance. Next to Josh is Susan Schroeder, who's a partner and vice chair of the Securities and Financial Services Department at the great law firm Wilmer Hale. She was the former head of enforcement and a management committee member at FINRA, and is an expert on the priorities and procedures of the regulatory bodies that govern the financial services industry, including the SEC, FINRA, obviously, stock exchanges, and state securities regulators. Next to Susan is Larry Gloston, who's the S. Sloan Kohl Professor of Banking and International Finance at Columbia Business School and an adjunct professor at the law school as well. He's a co-director of the Program in Law and Economics of Capital Markets, which is a joint program of the two schools, and a director of the Initiative on Financial Markets Regulation for the Program for Financial Studies at the Business School. And he's published many articles on capital markets and market structures. And finally, we have Brent Kuchuba, who is the founder of Spot Gamma, a financial insights company which applies its proprietary methodology towards modeling index and equity options and then provides unique content to subscribers. It has thousands of members and is regularly quoted in the Wall Street Journal, Bloomberg Markets, and elsewhere. And prior to Spot Gamma, Brent was a portfolio manager with Seven North Capital Management and a derivatives broker with Credit Suisse and Bank of America. Okay, let's start the program by asking Josh to give us a high-level summary of what the ad hoc academic committee's report on equity and options market structure conditions in early 2021 had to say about the GameStop phenomenon.
All right, thank you, Todd. It's nice to see everyone both in person and online. Our committee really set out to examine this core narrative that neither a short squeeze nor a gamma squeeze occurred in GameStop shares. We felt this is important because, as Todd explained, the SEC concluded from its review of the GameStop episode that the system largely worked as intended, and moreover, that there was little evidence that a short squeeze and a gamma squeeze were responsible for the price changes in GameStop shares. So we thought this was an important question to look at because it had direct policy relevance to how the SEC, in its post-mortem analysis, understood the GameStop incident. I'll just briefly highlight some of the findings from our report, and then our panelists here will talk in more detail about some of these. But at a high level, we looked first and foremost at the SEC's conclusion that there was no short squeeze. And we noted in our report that the SEC didn't use a data source which would have been very informative in our view, which is securities lending data. So as I explained to my securities students today, short sellers have to borrow stock from securities lenders in order to open short positions, by and large. Now, there's some exceptions to that, but in general, most short sellers have to locate shares for borrowing, and so the securities lending market could be a valuable source of data on short selling activity. And so what we did was examine the volume of shares which were opened in new short positions over the months preceding January. And then we also looked at the volume of shares which were returned by short sellers. And these two data points allowed us to conclude that the evidence that short sellers were returning a fairly large volume of shares, that evidence was more compelling than the SEC concluded in its report, in part because they didn't use data from the securities lending market. So that was our first principal conclusion. And our second principal conclusion was that the way that the SEC looked at the options market was unnecessarily restrictive. So they had concluded, for example, that a gamma squeeze required buying call options. And they pointed out that the majority of the trading was in put options. Now, not everyone knows necessarily the ins and outs of options trading, but the good news is we have Brent here, who this is what he does day in and day out, and he'll have more to say on this. But in effect, we concluded that it's quite possible to induce options dealers to hedge even if you're using put options. So particularly pre-existing put options that had been opened before the GameStop episode, so in effect, kind of short position. And we also noted that there were other ways that the hedging could have played out. And when we put it all together, we concluded that while ascribing causality here is going to be tricky, we're never going to be able to authoritatively say what moved GameStop's share price. We think the data points that the SEC was using were incomplete. And we thought that by bringing some additional data from the securities lending market and from other kinds of options transactions like put options and others, what we could do is help the SEC complete the picture. And while we'll, I'm sure, talk more about this, many of the conclusions in some respects may be similar. We do think that this episode teaches us really important lessons about the way that short selling and options trading may be moving the markets today. And we think that's something that the SEC should prioritize in its regulatory policy agenda.
Thanks, Josh. So, Larry, let's back up a little. For the audience, what is shorting and what is a short squeeze?
Simply, shorting is selling something you don't own. Well, yeah, you can do that. Brooklyn Bridge, think? Yeah, you can. And as Josh says, the way you can sell something you don't own is you borrow it so that you can deliver something and then you hope to profit from a drop in the stock price. That is, days down the road, the stock price drops, hopefully in your view, and you buy it back and return the share to the person who lent you the share. Okay? So it's a fabulous institution. Sounds evil, I suppose, to some people. Most CEOs think shorting is the worst thing possible. Should be banned. What the academic research suggests is that markets work much better the fewer restrictions there are on shorting. There are a number of reasons for that. One way they work better is if you didn't allow short selling, then the only way that the information that someone might have that suggested the stock was overvalued, the only way that could be represented in the market was for them to sell what they own, and no more than that. Think also of the interest in investing in information about firms. Well, you invest in information about firms, put simply, you get one of three things. You get really good news, you get nothing, or you get bad news. Okay? If you get no news, there's no trade there. If there's good news, you buy. If there's bad news, and there are severe short selling restrictions, you can't do anything. Okay, so now you're down to 1 out of 3 outcomes of your investigation leading to a profitable trade. You don't look for information so much. What does all of that mean? What that means is that prices reflect less of the fundamental information about the firm. Why is that a good thing? That's a good thing because the more information that the prices reflect, the more accurate are going to be real investment decisions. So this isn't just, Wall Street talking. We're getting down to Main Street of the effects of short sale restrictions. So it's an important thing to allow. I get why some people don't like it, but the fact is, the theory suggests it makes markets work better, and boy, so does the empirical work. So now what's a short squeeze? This is an interesting question because when Josh first approached me about thinking about this question, we had some preliminary data suggesting that there was more activity of short sellers covering. Oh, why do they have to cover their short sales? If shorting is not a problem. Okay, you're short the stock. That means that someday down the road, you're going to have to buy that stock to return it to the person that lent you the share of stock. Well, the person who lent you that share of stock has to be convinced that you're going to be able to buy that share of stock. But if the price is going up, that's going to get harder and harder for the short seller to do. So what the brokers do on behalf of the people who have lent the shares is say, okay, when you short sell the stock, you sell it, you don't get to keep the money. That money goes into a trust. And on top of that, you have to add more money. And furthermore, if the stock price goes down, you're in luck, you can take some money out of that fund. But if the stock price goes up, we're very concerned that you're not going to be able to afford to buy the shares, so you have to put more money into that trust. And if the hedge fund doesn't have that money to put in the trust, the only thing it can do is buy the shares. And that can push the price up, and that makes it even worse. And so the price goes up more and worse and worse. Okay, so that's what happens when a short squeeze occurs. The price goes up, and that induces short sellers to buy. That, in turn, induces greater price increases. Now, when we started looking at this project, short squeeze to meant a manipulation, an evil thing. Yeah, I was thinking of Philip Falcone was settled with the SEC over allegations that he manipulated a high-yield bond market where there were a whole bunch of people shorting the high-yield bonds. He bought up all the bonds with the idea of being able to squeeze those guys. But Josh kept using the term short squeeze, and so I said, well, there must be something more or less, but you know, how you think about this. Let me go look at the definition, and so where do you go? Well, you go to Wikipedia, and it says, large short-term spike in price forcing short sellers to cover their short positions. It says nothing about intent. It's just a thing that happens. Okay, so that's what the short squeeze is. I think it's quite possible that part of the reason that the SEC was not concerned about there being a short squeeze is they didn't actually come up with any evidence of the short squeeze the way I used to think about it, as concerted effort by a party or parties to drive the price somewhere. Now, there was some of that, but I'll stop right here and talk later.
Okay, so if shorting is good and a short squeeze doesn't hurt anyone, why should we be worried about this, Josh? What's the concern? And then I guess the second question would be, to Larry's point, well, everything I read in the paper said that Elon Musk and meme people, and they were all saying we're going to squeeze these hedge funds and all this. So wasn't there some kind of a concerted activity?
Yeah, so it's really, I think, an important issue because, you know, as Professor Gloston said, we really need to have short selling in the market. And so there is something in between costless, frictionless, super smooth short selling and extreme manipulated markets whereby, you know, no one can possibly survive as a short seller. And that in-between zone is a place where it might be incredibly difficult to be a short seller because you're subject to the sort of temporary, transitory, upward price pressures that I'm calling a squeeze, and that we ultimately use that term in our report. And that's something that makes it more risky and more difficult to be a short seller. And that's precisely what the retail traders and message board posters were describing as their aim. And from a public policy standpoint, a great deal of our report talks about these strong public policy rationales for encouraging short selling and for having short selling in the markets at a low cost. Because all of these risks that we're talking about deter short sellers from entering the market. And that's bad for the market. We need to have short selling in the market, and we need to have it at a low cost because we need to have short sellers being willing to take the risk. And in a market where short sellers might face pressure, even if that pressure falls short of the sort of extreme concerted manipulation that Professor Gloston was describing, it is still a bad thing for the markets to have short sellers deterred by this sort of activity. So we felt that it was important to talk really in the first half of our report about the many reasons why we need short selling, the kinds of costs that short sellers face, and then to understand this episode as posing public policy challenges precisely because it makes those costs more extreme for short sellers, it exacerbates the cost of shorting, and it harms our markets as a result. So we thought that was an important part of the policy conversation that needed to be discussed. How are episodes like these making it more difficult to be a short seller, and how is that harming our markets?
And I guess it's worth saying that, at least in my lifetime, there had never been this type of retail activity in the markets. I mean, the whole history of markets during my lifetime has been about the rise of the institutional investor and the reduction in retail. So here was a time where something new was happening, which was retail investors acting together through social media arrangements were in some ways creating the same issue as you would have had with a manipulative short seller, but without any intention, essentially, or a malevolent intention.
Yeah, can I add something in here? There was something else new, at least it was new to me. I'd never heard FOMO before, but I'm old, and so maybe I just missed it. But you did hear as much FOMO as you heard, let's crash the hedge funds. And so it was, it's sort of funny. The title to talk tonight is What Really Happened on the GameStop. I don't know. I mean, I filed this on Stuff Happens. Was the person who bought GameStop at $100 and sold it at $300, was that person wrong? No. Sometimes what we call a momentum trade works. It's not supposed to too much, but sometimes it does. So it was unparalleled. But it wasn't just a concerted effort to move prices. It was also fear of missing out.
Good point. So Susan, let's switch over and think with a regulator hat. So if this activity was happening in January, whether we could call it a traditional short sleeve or squeeze or not. Mm-hmm. So how would regulators typically think about this? What would they be looking for, and what would their concerns be under current law about this type of activity?
Well, the securities regulatory regime is a disclosure regime at the end of the day, right? Sunlight is the greatest disinfectant. And so you look at this kind of activity looking for the sort of manipulation that Larry described, manipulation that is fraudulent in some way, that is misrepresentative. And that was the big question for me watching what happened in January was, is it a manipulation if there are hundreds of thousands of people on Reddit saying, hey, we're going to manipulate the market? There's nothing hidden. There is no misrepresentation. And I think it is an interesting function of sort of the disassociation of investing from long-term value in stocks, sort of along the lines of whether it's momentum trading or an intention to have some sort of social impact through your trading. Those are not the traditional investment objectives that we might have learned about 30 years ago and when learning about the markets. We might have learned about 30 years ago. But I don't think as a regulator, you're all that concerned with activity that is not hidden or manipulative or fraudulent in some way, right? If it is a function of the markets behaving the way the markets are going to behave, a regulatory regime is not one where the regulator will come in and put a thumb on the scale and say, I don't want the market to work that way. I want it to go a different way. Rather, the aim of the regulator is to ensure truth in advertising.
Can I just say,
Sure, go
for
ahead.
my law students in the room and at home, here you have a preeminent lawyer giving you a great exam hypothetical, which is if a bunch of people say they're going to manipulate the market, did they manipulate the market? I mean, I just like that one so much. For those of my students who are watching, maybe it'll be on your final exam, because it's such a great point, right? I mean, that's at the core of this. It's that market manipulation.
What an incentive for those of Josh's students who are here today.
Can I ask a quick question to Susan, too? How does the regulator look at a situation where you had Elon Musk and a lot of these other billionaires in kind of the heat of the moment of GameStop, and he tweets GameStonk, and the stock goes up 400% after it had already gone up? So is there do the regulators look at that at all and say, you want to talk about manipulation? I mean, why else would he do that, right?
So I'm not going to comment on any particular
Plead the
market
fifth, it's fine.
participant or any particular aspect of GameStop. Like, I can't. But I would say that you're looking at things like, is this person acting as an investment advisor, right? There are theories that you can use to say, is this person participating in the market in a way that requires licensing or requires, some sort of specialized disclosures? And of course, you'll think through your regulatory regimes. But you run into the First Amendment at some point, right? And whether people who are on social media expressing an opinion and not accepting compensation for that opinion, are they violating the securities laws? I mean, it's an interesting question. It's another good hypothetical.
Are they trading the stock at the same time?
Right.
So, Brent, now that we've got you engaged, here's a question. Josh mentioned the potential of a gamma squeeze in his report with the rest of you. What is gamma, and what would a gamma squeeze be, and why do we care?
Sure. So gamma is what's called the derivative of delta. And basically that's just fancy lingo for explaining how options market makers like Citadel is a well-known one, have to hedge their options trade. So anytime, generally when you go into your Robinhood platform or Interactive Brokers or something and you buy or sell an option, the counterparty on that trade is a market maker, an options market maker. And so they have large portfolios of options, just sort of like a hedge fund might, and they need to hedge their risk. So as people are coming in and buying and selling options, they are typically trading the underlying stock, right? And they're adjusting the amount of shares they hold to, again, maintain their risk. Now, a gamma squeeze in this situation is if everybody is coming into me and I'm the market maker and everyone's buying call options, I am short a call option. So as many of you know, if a call option, if the stock goes up and you own a call option, you're making money. That's great. Well, if I'm short those calls, I'm losing money as the stock goes up. So I have to, when you all come to me and you buy calls from me, I immediately sell a bunch of stock. That's called the delta hedge, right? So at that moment in time, I'm hedged. And if the stock continues to go up, I must continue to buy shares incrementally to maintain my hedges. So that is the gamma squeeze function. When people come in and they buy calls and the stock starts to rise, I need to, as a market maker, continuously hedge my position, hedge my risk by buying more and more shares of stock. So as you can imagine, that is the squeeze part, right? When the stock starts to ratchet up, particularly like GameStop in those situations, or AMC, I must continually buy shares of stock as it goes.
How much of that was going on in this circumstance?
It was an interesting. So what I looked at is into December and early January, there was a lot of call options already starting to come into the market. So before sort of the heat of the moment again, where on the 25th you had big hedge funds go down and things like that, there were already a lot of calls coming into the market, and the stock had already performed very well. I think it was up, 50 to 100% going into sort of mid-January. So a lot of these positions were sort of preloaded, right? In that there were call positions that were positioned out in time and up in price. So all you needed was a catalyst to invoke more hedging as the stock went up. So it's sort of like a map in a way where you can look at the stock and say, look, there are all these call positions that are higher in price. And as the stock gets closer to those call positions, the market makers and dealers have to buy more and more shares of stock. So heading into sort of before the SEC really, I think, investigated where the positioning was, they started too early in time looking at where positions were laid. The positions were laid out before their analysis arguably started, and that sort of create a trap, so to speak, or preload the squeeze.
Okay, so when they looked at the markets, they were not focused on the already placed options positions, which were going to create problems as the stock rose for these other reasons.
That's right, and that was our view. There was a fascinating, amount of positions waiting for that squeeze to sort of invoke, and a lot of times those things need a trigger, and that's a well-explained thing. But this phenomenon had happened in Tesla for a long time, and other names like that, and it's also an interesting thing in regard to the shorts, because with the call buying, what makes it so interesting is if you think about a stock, there's technically no upper bound, right? If you short a stock, the stock can go to zero, right? And that's how much money you're going to make. If you buy a stock, the most you're going to lose is whatever you paid for it. But if you short a stock, there's no limit technically to how high a stock can go. And that's the same thing when you own a call, right? If I own a call and it's on GameStop could go to $1,000, it could go to $10,000 a share, right? So margin comes into this a lot, and that I think plays into a lot of the squeeze. So you have this double-loaded sort of weapon, we called it, of gamma squeezing at the same time as the stock squeeze, and those two coupled together, they intermeshed very nicely to
And Josh, do we feel any different about gamma squeeze as a conceptual matter, a good thing? The types of options, Larry? I mean, no difference really. It's just another method of price discovery.
You want to take that one first?
Go ahead.
Well, I'll just say I think there's really two issues here which go back to what Susan was saying earlier. One is that the current regulatory enforcement paradigm, and here I'm not just in a sense blaming the regulators, I'm blaming the policy regime we have. I'm describing the state of the law, not just the state of the people who are enforcing the law. The state of the law is such that we don't really have a way, I think, under existing law to very clearly capture gamma squeezes and short squeezes which lack manipulative intent. I think it's fair to say. I mean, there are cases where courts talk about artificial prices and things like that, but as my students know from today's lecture, the courts, are looking for deception in most of these cases, and that's for a number of legal reasons. And so, we don't have a proactive regulatory approach which says, let's try to make sure that supply and demand in some genuine economic sense, if that can even be defined, and maybe the economists here on the panel will tell me it can't be defined, but we recognize that when there's gamma squeezes or short squeezes, the price number is not authentic or as authentic as it is in a liquid market where these characteristics aren't present. But I don't think we have developed at the policy level the tools to distinguish between these cases. And I think that leads to a lot of interesting consequences, like the kinds of hypotheticals Susan was talking about, and a sense among market participants that a lot of this is vague and unclear. And the other thing I'll just say is, I think one of the challenges, and this goes back to a point also Todd made earlier, is the relationship between what is being traded and what is being said. And I think here actually the SEC is on firmer ground, and there have been social media type stock promotion campaigns where people have said one thing and done something different. But that's a particular set of cases, and it doesn't capture everything, and it may not have captured even the majority of what happened at the end of January.
So Larry, quickly, anything you want to add to that?
Clearly, the hedging is absolutely benign. And the hedging doesn't matter whether the price is right or wrong. You still got to do it, right?
Right.
So, yeah, I don't have, no problem.
So you mentioned, actually Brent mentioned Robinhood. So another thing that was going on during this period is we had the emergence of free online trading through the fintechs like Robinhood, and then the adoption of zero-cost trading by Schwab and TD Ameritrade and all the others. So is any of this shaping the role of gamma, options trading, anything we've talked about before? And we'll move on to the question of whether payment to order flow has a similar effect, but start with the whole concept of free trading. So Josh, perhaps, and then Susan.
I'll just very briefly say, I think we are, in this brave new world in part because people are trading options at a scale they weren't trading before, and that's because it's so easy and fun to do so on Robinhood. I personally haven't traded single stock options on Robinhood, although I have played around with the S&P 500, and it's very dangerous, but it's kind of fun. It's kind of fun to click the button and get the reward. So
Inversely correlated with age, I think.
yeah. So that's the world we live in, right? And so I do think that's changing things, but the rest of the panel, I'm sure, has many more intelligent things to say than that.
Brent?
I would say that one of the features of options is that it's leverage, right? So if you couldn't afford 100 shares of GameStop when it was trading at $100, well, you could probably afford the call option, right? And when you buy the call option, you're forcing a counterparty that is the market maker to buy shares of stock, in theory. So that's leverage, right? And so you sort of gamified, obviously, trading in a way. A lot of people were given stimulus funds. They were given this app with nothing else to do, sitting at home because of the COVID situation. So they all just brought small amounts of money, which was levered up through the use of options, and you unleash kind of volatility in markets.
I'll just comment. Actually, last week or the week before, FINRA put out a notice requesting comments from market participants on the sale of complex products, including options, to retail investors, essentially asking, should there be more gatekeeping by broker-dealers, right? In a self-directed environment where years ago you weren't able to trade options in such a frictionless way, there were necessarily some financial obstacles that prevented people from trading options in the way that they may now in any commission-free app. And FINRA was asking, should that be the case? Or should broker-dealers essentially prevent certain retail investors, depending on their level of sophistication or their financial means, whatever it should be, should they be prevented from trading options? And I just want to say that as someone who plans to be a little old lady one day, that I would like to be able to make my own decisions when I am a little old lady. And the fairly paternalistic approach that the regulators have taken here that are baked into FINRA's questions about can retail investors be trusted to make decisions in the financial markets, I find that approach to be troublesome. And I really appreciate that the dynamics of options trading have changed as the financials of options trading have changed. But I don't know that that's a bad thing. I think we want to encourage liquidity in the market, and we want to encourage the democratization of finance.
So a lot of this democratization, as people who have looked at this can tell you, is paid for by payment for order flow, because the only reason why trading is free is because there's compensation flowing to the brokers from other sources. So a lot of the commentary about GameStop at the time focused on the impact that payment for order flow was having on the creation of the meme stock phenomenon, the trading in the stock and options. Is this the right thing that we should be concerned about? Is this actually a major driver of what was going on? I'll just ask everybody to chime in. Start with Larry.
Larry has an opinion on that.
This is just nonsense. Am I clear enough?
Say that again.
Yeah, no, brokers used to get commissions for trades. So that gave them no incentive to generate volume, right? No, actually, it's higher power incentives than payment for order flow. Look at actually, let me step back a little bit. I do not have a Robinhood brokerage account. I think that they have made fabulous contributions to the way brokerage houses work. They were the first to introduce free commissions. They were the first to say, if you don't want to buy a share, you can buy a half a share. You can buy a quarter of a share. It's no problem for us. We can do that. That's what brokerage houses should have been doing a long time ago. So I think they're absolutely wonderful. Are they a real brokerage house in the old-fashioned sense? No, they're not. They're a marketing company. They're selling the idea of investing. Do I think that's a bad idea? No, I think that's a fabulous idea. How good are they at getting trades done? They don't know anything about that. That's not their business. Their business is to provide the service for people who need brokerage services. So someone's got to get the executions done. And so who does the executions? Well, mainly it's Virtu, Americas, and Citadel. Yeah, and both of those want to get the trading done. And they're willing to pay for the privilege of doing that. And so this payment for order flow is largely prices that are determined in a competitive market for services that Robinhood needs because they don't know how to get executions done. Should they be required to get executions done? Well, I don't think so. They're required to provide their customers with the services that they need. Part of that is getting executions done, but there's this firm over there, Virtu, two firms, Virtu and Citadel, who actually do executions very, very well. So I consider it completely benign. On this part, there are other things about payment for order flow. People in the industry actually say PFOF. That's one of the ugliest words I've ever heard.
They do, in fact, call it that. So a lot of the criticism really around Robinhood and payment for order flow comes from some of the marketing aspects of what they've been doing, right? Which the confetti showers and the sort of behavioral finance aspect of stimulating activity.
Which actually had stopped before the GameStop episode.
Due to significant criticism. But that's been driving a lot of the regulatory concerns, Susan. And I wonder, what's your view about how regulators, where are they on this question? It keeps coming up. It was even mentioned in the SEC report in passing.
It was this notion of gamification as creating incentives to increase trading to drive PFOF revenue. Again, I'm not going to comment on any particular market participant, but this, at a high level, this notion of gamification, I find to be very analogous to 50 years ago when I was probably a privileged white male who actually had the resources that allowed me to invest in markets, right? When there were a lot more financial obstacles. Back then, I had a broker who would call me and say, hey, this particular stock is tanking, you better sell it. And that same broker might take me and my wife to a Broadway show or take me out golfing. And I would enjoy being entertained that way, and it would probably make me trade more with that broker. And I would appreciate when the broker called me and gave me news about a stock that I was interested in. And I don't find confetti on my phone or a pop-up message that says, the stock that you're interested in, something happened here, I'm going to tell you about it in real time. I don't find those to be that different.
Josh, so what's your view? Are regulators going to do more in this area, or what?
Well, I think so. Surprisingly, or maybe not. You're going to find me agreeing with Larry and Susan on much of this. I actually think, and this was part of the motivation for our report, that there was a sort of knee-jerk, almost political reaction to make GameStop about payment for order flow and the gamification of the trading experience. I think, to be perfectly candid, because it served certain political goals, I think that it fed a particular narrative, a consumer protection narrative, which, whether you think that's a good idea or a bad idea, it's a political narrative. And I think as a result, we kind of missed, to some extent, the narrative of what really happened to GameStop. And that's in part why I wanted to do this report and why I think people were interested in these questions. Because if we're talking about payment for order flow, all day and all night, and we're talking about the gamification of confetti, we're not talking about the increasing cost to being a short seller in the market. We're not talking about that. And so, because one displaces the other, unfortunately, in our society today. We'd have limited attention and limited bandwidth. So I want to make sure we're talking about the latter as well. I want to make sure we're talking about what it means to be a short seller in an environment where people online may band together to make it much more difficult for you to be a short seller. I filed an amicus brief along with other securities law professors in a case where a court held that an intentional action by a corporate executive to squeeze short sellers was not actionable under the securities laws. And we opined in this amicus brief that that's incorrect, that the securities laws today, even today, reach intentional efforts to squeeze short sellers. In my view, protecting short sellers from these sorts of abuses and forms of market manipulation against short sellers, even when intent cannot be proven, is a really important regulatory policy goal. And it goes to the broader goal of upholding the integrity of our markets in all directions. So when the narrative becomes about payment for order flow and gamification of confetti, to some extent, I think we're kind of missing what really happened. What really happened here was short sellers got driven out, at least some of them, out of the market. Options trading has made these stocks far more toxic and volatile than they were in the past. That makes the markets far less stable, far more volatile. It makes it hard to be a short seller. That makes prices, as Professor Glosson said at the outset, less accurate. And that means we start to see things like stock prices wildly moving around in ranges that are not meaningful for society. So in my view, in a sense, it's sort of like a low-hanging fruit to go after payment for order flow in these things. There's an immediate political payoff instead of thinking about the bigger and deeper question about volatility in the market. Do we want to be in a market where there's so much volatility, and what does that mean for the real economy? And I think those are the questions that, from a public policy standpoint, are actually more important. And so in this respect, I actually agree with my co-panelists that we should be focusing the conversation on other topics and not just sticking with payment for order flow and gamification of confetti.
Okay, that makes a lot of sense. Let me ask the sort of guy in the street question of Brent, which is, do you think that the extension of easy option trading to people who don't have advanced degrees, shall we say, or extensive trading experience, is that a good thing?
I'm for democratization and open access to everybody. So you can gamble on football games now. If you want to play in the markets, you're swimming with sharks. I mean, that's just kind of how this works. So a lot of people can be successful at it. And I think that to sort of prevent people from trading, it's sort of like a freedom of speech thing. You go ahead and I just want to add one thing about Robinhood. The other problem with Robinhood is, as was mentioned, is that their risk controls were terrible. They just weren't a broker. And that's really what ended this whole saga, that they didn't maintain enough sufficient capital. They didn't have the safeguards on to monitor the explosion of trading. And just like an individual trader can get a margin call when they run out of capital, that's what happened to Robinhood, right? They blew up. So a lot of these people who were in GameStop for sort of a motivation of trying to take it to the man and stick it to the system, and they wanted to take down Wall Street. Our view is sort of, well, they succeeded, right? I mean, they blew up one of the biggest retail brokers there were, and that ended the.
So just, again, to be devil's advocate, I'd say the thing to keep in mind is this all happened during a period of rising equity prices. So democratization is fine as long as everybody's making money. How will we feel about it when they're not is the question. And typically the reaction is, as you described, it's a consumer protection reaction. And so depending on what happens in equity markets, we may see more activity on that side because there are differing views about the extent to which people should be allowed to gamble or do other things. The general trend has been very much in favor of open access to all types of financial bets.
Right.
Susan, do you think that there's going to be any regulatory and or statutory response to any of this? Are things happening in Washington in response to this? I know there was a lot of sound and fury early on, but I haven't heard much recently.
I mean, there are discrete proposals that the SEC has put out that address, I think, some specific elements of what we saw. One goes to, several go to the availability of data that Brent and Josh were talking about, understanding who was purchasing and were they purchasing to cover, for example, during the events of January 28th, 29th. The SEC put out a proposal that would require brokers to actually mark trades as purchases to cover shorts, as opposed to right now, you just know it's a purchase. The similar requirements that would require enhanced reporting of short positions, whereas now, as Josh described, there is a lot of data manipulation and kind of guessing and figuring out what short positions existed on the street on January 28th. So you'll see the SEC, I think, moving towards, again, disclosure initiatives, right? Making sure there is data, making sure there is factual information available to the market that helps inform investors' decisions. But I don't see them, taking steps to prevent the kind of market dynamic we saw that Josh would describe as a short squeeze.
Is the current state of information about short positions adequate for the purposes of what you'd like to see from an economic standpoint? In other words, is it a good thing or a bad thing to disclose more about these positions, and how would you deal with it?
Yeah, so the SEC recently proposed rules that are, I think, a really important first step towards greater disclosure, really, I should say greater reporting of short positions. There actually isn't much new in the way of public disclosure. There's some new aggregate disclosure that they're proposing. But the SEC, I think, and FINRA to a large extent have been handicapped by very spotty data availability. That is starting to change. In the last few years, we're seeing substantial changes. I think the CAT, the Consolidated Audit Trail, is a big one. But we're also seeing now with this proposal a specific set of reporting metrics which may help SEC enforcement understand what's going on in the short selling market in real time, which is something that I think, when GameStop was happening and people were asking me, what's the biggest regulatory deficiency right now? My response was data. I think that the problem, and as someone who's been involved, I advised DOJ on cases like these. So having seen the data generating process up close and personal, it's really archaic. And I think that's beginning to change. And so what's happening is we're now seeing new forms of reporting, new forms of analytics, and hopefully, and here I agree with Susan, we can't really stop markets from being markets, but hopefully we can respond a little faster. I mean, some of these cases, that take 3 years from when the thing happened to when there's finally a sense as to what happened, you just scratch your head and go, I mean, is it possible to do any better? And I think the answer is yes. We're starting to see it. It's really a technology problem. And now the proposals that are coming out are going to allow the SEC to respond and look at manipulative activity much more quickly. So I think this is actually a really exciting time. The emphasis and investment that's being placed on data analytics now is, I think, unprecedented. And it's a real change. It's sort of like finally we're at this moment. That's my view.
Oh, I think the Consolidated Audit Trail is a game changer in terms of data, but I also think it was a response to the flash crash, which was 2009, right? So that's how long it takes to build the next technology. That's how long it takes to get the industry to a place. I mean, in some ways, the idea of a Consolidated Audit Trail database is already outdated, right, from the time that it was first envisioned. So I agree, I think there's a big step forward with CAT coming online, but this will continue to be a problem.
Okay, so let's start taking some questions. We have some online questions. Is there anybody in the audience here who wants to ask a question? Right here.
Question, it was said throughout the first couple of minutes that short sellers have an essential role within the market. I would like to hear an explanation from the panelists why that is, and if all the panelists agree that short sellers are essential to equity capital markets.
So the question was, early on, someone said that short sellers are essential to the market, and the question is, could you explain more why that's the case, and do you all agree about that? So, panelists, anyone?
Yeah, we agree.
We agree.
Okay, want to give?
So why?
Want to give? You did, Larry. So
I'll give an example.
Okay, good.
There's many times where short sellers have uncovered fraudulent activity at companies that arguably wouldn't have been exposed otherwise. I mean, Wirecard comes to mind as one of the major examples there. So I think that they provide a necessary service to the market. And look, if your company's fundamentally sound, this is a market which in general takes capital in the default direction of the market through inflation and all these other mechanisms is to send stocks as a whole higher, right? If you just look at the way that things are structured, in my view. So a short seller is going against the tide. The odds are against them sort of from the onset. And so they really have to find some compelling information to express their views. And I think there's a lot of situations where they've been proven right and exposed and done the markets a service. So.
Okay, let me have an online question here. Can large whales manipulate the price of a stock through options when the stock has negative gamma?
Yeah, I mean, so much of trading is about, there's technical analysis and there's fundamental analysis, and I would just phrase it as positional analysis. I mean, if you've seen the movie Wall Street in 1987, they would talk about knowing whether people are long or short and how is somebody else positioned and can I squeeze them in their position. So when you think about gamma and options positions, people are trying to estimate how are market makers positioned and knowing how they may behave and can I force them to take action, right? In August of 2020, there was, this famous talk of SoftBank, right? And they had big options positions and were they trying to squeeze the market? And so there is this understanding of how market makers have to hedge and how the options community or liquidity providers have to hedge, and can we force them to take action based on our activities? So one large trader can, or as we saw, you can get Wall Street bets and an army of small traders to sort of, force action out of somebody.
So one of the other online questioners has asked an interesting question, which is the SEC has from time to time restricted short sales of financial stocks such as banks and insurance companies. If short selling is a healthy part of financial markets, why should these securities be exempt from short sales? And I'm not sure it was the SEC that did that in 2008. It was Treasury, I believe. But so
I think there was an SEC freeze, yeah.
So
At least in the public, for the bank holdings.
So the short answer to that one is it was a concern about runs on banks at the time of the financial crisis. And I had personal experience with that because unfortunately the list used was the primary government securities dealers. And that meant it excluded the bank that I worked for, which was heavily exposed to mortgages. I won't tell you the story here about our call to Secretary Paulson to try to point that out to him and his reaction. But at any rate, that was the only reason that I'm aware of that action of this type has been taken there. It's otherwise, have there been examples of bans on short selling for particular reasons?
I believe there's been some individual names throughout that. I can't think of any examples there, but
Any other questions here? Right there.
Yeah. So, hey guys, I had a question about payment for order flow that I've been trying to understand. When Citadel pays Robinhood for order flow, are they doing that because they can kind of give poorer execution to Robinhood and kind of profit more on the bid-ask spread? Or are they giving that because they can benefit from the data somehow in some other way? Or is there some other reason? Why is it that Citadel is willing to pay Robinhood for order flow?
Right, I'll try to reproduce that. So the question is about payment for order flow, and the question goes to, what's in it for Citadel? There must be something. Is it taking something from Robinhood's customers when it does that by its execution, or is there some other benefit, and why is that happening?
Yeah. No, they're not taking something from Robinhood's customers. In fact, they're providing some price improvement over the quotes that are over the national best bid and offer that is available in the market. So somehow they are able to take the quotes that are in the market, provide even better prices than that for Robinhood's customers, and on top of that, pay something to the brokers and have something left over for them. That's sort of your question, right? Well, I promise I won't go in the weeds too much. Where does the spread that we observe in the market between the bid and the offer, where does that come from? Sometimes it just comes from the fact that we trade on pennies, and you can't get any smaller than that. But a stock like Amazon has a spread of 10, 15 cents. Where does that come from? Well, you think what the data tend to show is that a large part of that spread between the bid and the offer comes due to the fear that the people who are providing quotes, the fear they have of trading with someone who has better information. You put the offer here, it gets hit. That tells you there's one or two possibilities. One, is some idiot came in and hit my offer, and I'm really happy about that. The other possibility is someone knew that that offer was too low, and I should be pricing higher. Balance off the two things, you get a quote. You compare the order flow that Citadel and Virtu is getting from Robinhood. Do you think that's a lot more informed than the overall market? Or do you think maybe it might be somewhat less informed than the overall market? Probably somewhat less informed. Here's the interesting observation. Robinhood gets paid on the order of 35 cents per 100 shares. That's an astounding amount of money. In contrast, interactive brokers, who actually have a very sophisticated clientele, are not asked to join the club. They do not receive payment for order flow because Citadel has determined that the order flow from interactive brokers is not profitable. There are too many interactive broker clients who know stuff, and so they can't make that money. So it really is a difference in how dangerous the orders are from different brokerage houses. Robinhood's orders are not very dangerous.
I would just add quickly in the options market, if I could, the spreads tend to be much wider in the options market, obviously in a penny. There's also over 15 different options exchanges. Each options exchange offers a different payment mechanism to the market maker. So if Citadel puts out a bid and offers liquidity, they may get paid 20 cents on the Miami exchange, and if they lift an offer on another exchange, they could get paid there. So once the order comes into them, they can route to a bunch of different venues, which has different economics, and offer them a little bit of something extra. So there are some mechanisms and sophistication in the way that they place orders as well that can be advantageous.
And I would just add that there is a regulatory framework that governs this, right, which is a best execution obligation that belongs to every broker-dealer. Any broker-dealer in that chain, whether it's the retail-facing broker-dealer that might have a mobile app or the routing broker-dealer, such as a Citadel or a Virtu, they all have an obligation to ensure that the executions that they're providing to customers are the best execution they can get for that customer. So they're not going to be providing executions for customers well below the NBBO. They would be violating their best execution obligations and opening themselves up to a great deal of regulatory risk if they did that.
And that's regardless of if they go into a dark pool, which is where those prints usually take place in stocks. And on options, you have to print on an exchange. At least in a dark pool, you still can't violate NBBO. So national best bid offer.
Dark pools are still subject to the same obligation.
Yep.
Yes.
So there's one
Go ahead, sure, follow up.
Robinhood is effectively creating value for themselves by selecting uninformed investors and making money off them by selling it to Citadel is kind of what you're saying, right?
Yeah, I don't know that Robinhood selects its clients. I think its clients select Robinhood.
Yeah, but they're marketing in a certain way
Yeah.
that's kind of drawing in uninformed traders,
Yeah, and
which enables Robinhood to then sell it and get some order flow from.
that's right. And what would happen, of course, is if that changed, the nature of the clients that Robinhood has changed so that they were much smarter traders, Citadel would figure that out.
Yeah, and they wouldn't pay.
And let's be clear that PFOF has existed for decades, right? Broker-dealers received PFOF in addition to charging commissions for dozens of years.
Yeah.
But not forever. You know who started payment for order flow? Bernie Madoff.
Yes, Bernie, it all comes back to Bernie Madoff. Okay, one question from the field is, one topic that hasn't been covered is sustained synthetic naked short selling. Naked short started to be talked about on social media, then Main Street and now industry insiders come and speak against naked shorting. What perspectives do you have on the distinction?
I'll maybe say something about this. I think that, our discussion about the importance of short selling, it doesn't follow that 100% of trading activity that includes short selling is beneficial for markets, right? I mean, it wasn't like the Reddit crowd was saying, let's stop synthetic naked short selling, right? I mean, like that would be interesting. It's not clear they could do that. But, you know, I think it's important to remember that our conversation around the value of short selling, much like a conversation we might have about the value of liquidity in the markets or the value of IPOs, it doesn't mean that 100% of IPOs are good IPOs, okay? And so it doesn't mean that 100% of short sellers are good short sellers. And, you know, some of you know I've written on the topic of market manipulation on the short side as well. So, you know, these two goals are not inconsistent, and I think short squeezes are not the right remedy for whatever abuses or manipulative forms of short selling activity that one identifies. A short squeeze is really just two wrongs not making a right. You know, we don't need to make the markets less liquid and more toxic because we think that there are problems. Instead, we need to focus on the problems and talk about those problems. So, you know, our report really focuses on what happened in the GameStop episode, which looks like making it a lot more difficult for short sellers to short. That's unequivocally bad, and it doesn't matter that there might be certain abusive forms of short selling out there. Those forms need to be addressed, and you know, we could have a separate conversation about that. But I think, you know, this report and this project is about what happened in January and what that does to short selling as an institution.
Okay, so let's bring it back to the panel here. And I have two final questions for everybody to do in a lightning round. Do you think the SEC or FINRA need to do anything to control the negative aspect of events like GameStop? And if so, what should they do? Starting with Brent.
I don't think they needed to do anything. I mean, this is sort of the new paradigm in markets. There's a lot of liquidity out there. People want access to the markets, and you can make a case that the Fed and a lot of the policies have created this environment. So, and these activities are nothing new. I mean, you could look up the Volkswagen Porsche saga from 2008, where there was an epic squeeze that was very similar if you read the news articles about what just sort of occurred. So I think there needs to be some more transparency, more data transparency in dark pools and around short selling, and make sure that everyone can access the same data, right? Not just sort of large institutions have access to different information than you know, the average retail trader, and let it be an equal playing field with everyone has access to the same data, and that's what I asked for.
Larry?
No.
I kind of thought that was the answer. Susan?
Yeah, no.
Well,
All right, Josh.
So, as a law professor, look, I think, you know, I agree, as I said before, that the GFOF and those issues are probably a waste of our time. I think, you know, the SEC hasn't recently grappled with the broader question of what it means for stock prices to reflect transitory, whatever you want to call it, transitory short squeezes, transitory options hedging. I do think the SEC or Congress at a fundamental sort of basic level should start to think about that question. We talk about efficient markets, right? Well, what does that mean in a world where prices are not set because there's disagreement over what a company's worth, but because someone had to hedge a derivatives exposure, all right? So I do think that the policy agenda at a very fundamental level we need to start talking about this problem. I don't think we're gonna get easy solutions right now, and I don't think government telling us what prices should be is the solution. But I do think that we need to start understanding what price changes mean, and not all prices are created equal, okay? Not all price changes are the same. Some price changes are the product of intense disagreement, and others are the product of a gamma squeeze, right? I mean, and like that fundamentally, I think, needs to be part of our conversation, and that's something that the SEC and Congress could start to look at.
Okay, now here's the bonus round. Remember we said that GameStop was trading for $3 in August of 2020. What's your explanation for why GameStop, which lost $380 million last year, by the way, closed over $150 on last Friday?
No,
Josh?
I'm passing on that one. Let the smarter people figure it out.
I'll risk waxing poetic here. I think this is a cultural moment in which sort of the real economy is becoming disassociated from stock prices, whether it's fear of missing out or a sense that there are other factors that contribute value to a stock that are not related to the long-term value of that investment. We even see the SEC putting out rule proposals around ESG, right? And there's an argument to be made that ESG characteristics of a company may not actually go to the fundamental investment characteristics of that stock, but people are making investment decisions based on those factors, based on those decisions. I think we're in a moment where market prices are coming to reflect more than just the long-term value of the underlying company.
Larry, does this mean the efficient market hypothesis is dead or alive and
Oh,
well?
no, it's all non-fungible tokens.
Yeah, one of the reasons these stocks are going up is they've all announced they're investing in NFTs. But Brent, you have a view on this as a?
I mean, there's the saying, you know, value is what someone will pay for it. So I don't know.
That's the trader's mantra.
Maybe it's all the Oscars attention that's got the stock up again today. But I think my explanation is that I think the float is just decreasing over time as more people buy and hold because of a movement, right? And so as the float gets smaller, you know, it's easier to have the stock jump up higher. And so they're investing in gold mines and NFTs and whatever else it is. So
Can I just say, that's a really important point. And I think, like, we talk about index investing as a good thing because it reduces our portfolio cost, our 401k costs, but maybe this is a consequence of index investing at some level, right? Like, that's a conversation we need to have.
Right. I mean, totally different topic, but the assumptions we make about markets are being challenged by the prevalence of index investing and all types of activities. So, all right. Well, thank you very much, those in attendance and those online. I hope you enjoyed yourself, and if not, don't tell us. The Richmond Center thanks you for your participation, and hope you'll join us on future programs.